Hello and welcome back to the Unlearned Investor. I am your host, and this is the season finale, episode 9 of Fundamentals of Investing, Wall Street Terms and Meaning. Before we begin, the usual disclaimer: I am not a financial advisor. This podcast is for educational purposes only. Always do your own research and speak with a certified financial professional before making any investment decisions. Okay, let's get into it. Imagine you open a finance article on a Tuesday morning. The headline reads: Hawkish Fed signals delay broad market rally as shares plummet. Nifty 50 enters correction. You understand the words individually: hawkish, broad, plummet, correction. But strung together, it reads like a foreign language pretending to be English. Here's the secret nobody tells you. That's the point. Wall Street has its own dialect, not because finance is too complex for plain English, but because complicated sounding language keeps regular people feeling like outsiders. It builds a moat around an industry that, at its core, is just buying things and hoping they go up. So, for the final episode of season 1, we are tearing that moat down. No jargon, no textbook definitions, just the words you see every day, explained the way I wish someone had explained them to me when I started. I've grouped these into 5 parts. Each one builds on the last. Let's begin. Part 1: The mood, where the market is and how it moves. We start with bull market and bear market. Two animals, two moods, one of the most overused metaphors in finance and one of the most useful. A bull market is when prices are rising and people are optimistic. The technical definition is usually a sustained rise of 20% or more from recent lows, but you'll feel it before you see the number. Everyone at the dinner table suddenly has a hot stock dip. A bear market is the opposite. Prices fall 20% or more from recent highs. The mood turns. The hot stock dips disappear. Headlines stop saying rally and start saying rout. Why a bull and a bear? The popular story is about how they attack. A bull thrusts its horns upward, a bear swipes its paws downward. Whether that's the real origin or a story Wall Street made up later, the image sticks. Here's what most articles won't tell you: bull and bear markets are descriptions, not predictions. Nobody rings a bell when one ends and the other begins. You only know in hindsight. Anyone telling you we're definitely entering a bear market next quarter is guessing with confidence. Next up, shares plummet and shares surge. These are headline words designed for clicks. Shares plummet means a stock or market fell sharply, usually in a single day. There's no official threshold, but you'll typically see plummet used for drops of 5% or more in a day. Share surge is the same thing in the opposite direction. A sharp, sudden rise, other words in the same family. Shares tumble, slide, slump, crash, all downward in increasing severity, and shares rally, jump, soar, rocket, all upward in increasing excitement. Here's my Warner's take after watching headlines for years. These words tell you more about the journalist than the stock. A 3% drop can be called plummeting on a slow news day and easing slightly on a busy one. The actual percentage matters more than the verb. When you see one of these words, your first instinct should be to look up the number. A 1% drop is not a plummet, it's a Tuesday. Now, volatility. If plummet and surge describe a single day, volatility describes the pattern across many days. Volatility is how much prices move. Up or down, doesn't matter which. A stock that swings 5% every day is highly volatile. A stock that barely moves a percent a week is low volatility. Here's the thing most beginners miss: volatility is not the same as risk. A wildly volatile stock that doubles every 5 years is a great investment. A boring low volatility stock that slowly bleeds to zero is a terrible one. Volatility is just noise. Risk is permanent loss of capital. You'll often hear the market is volatile right now. That's a way of saying nobody knows what's happening, and prices are jumping around as different investors panic in different directions. Volatility usually rises during uncertainty: wars, elections, central bank decisions, surprise earnings. For long term investors, Volatility is your friend. It creates the opportunity to buy good companies at discounted prices. For short term traders, it's the thing that ruins them. And the last term in part 1, correction. People mix this up with crash and bear market all the time. Worth clearing up. A correction is a fall of 10% or more from a recent high. It's smaller than a bear market, which is 20% or more, and usually more dramatic than a regular pullback, which is under 10%. The name itself is telling. Wall Street calls it a correction because the implication is that prices got too high and the market is simply correcting itself back to reality. A normal, healthy thing, not a disaster. Corrections happen roughly once a year in major markets. Most people barely remember the last one. The headlines feel apocalyptic while they're happening. Then the market recovers and everyone forgets. The simple ladder to remember: pullback under 10%, correction 10% or more, bear market 20% or more, crash sudden, severe, usually in days, same direction, different intensity. Part 2: The scoreboard. How we actually measure the market. Let's start with the term broad market. The broad market just means the market as a whole, as opposed to a single stock, a single sector, or a single industry. When a journalist writes, tech stocks rallied, but the broad market fell, they mean technology shares went up while most other stocks went down. Think of it like asking how did the class do on the test. The broad market is the class average. Individual stocks are individual students. One student can ace it while the class average drops. That's a sector rally in a falling broad market. Which brings us to the index, the S&P 500, the Nasdaq, Nifty 50, Sensex. An index is a basket of stocks chosen to represent something larger. You can't track every stock in a country every day. There are thousands. So smart people picked a representative sample, weighted it by company size, and turned it into a single number. When that number goes up, the market went up. The big ones you'll see constantly. The S&P 500 is 500 of the largest US companies. It's the most watched index in the world because it represents roughly 80% of the total value of the American stock market. The Nasdaq composite is heavily tilted toward technology: Apple, Microsoft, Nvidia, Google, Amazon. When tech is hot, Nasdaq outperforms. When tech is cold, it underperforms. It's the volatile cousin of the S&P 500. The Nifty 50 is India's S&P 50 of the largest companies listed on the National Stock Exchange: Reliance, TCS, HDFC Bank, Infosys. The benchmark for how Indian markets did today. The Sensex is the older Indian index. 30 large companies listed on the Bombay Stock Exchange. Nifty 50 and Sensex move together about 95% of the time. The difference is mostly which exchange you're tracking. Why do indices matter? Two reasons. First, they are the scoreboard. They tell you the mood of the market in one number. Second, and this is the bigger one for most investors, you can buy them. Index funds and ETFs let you own a small piece of every company in the index in a single purchase. That's how most retirement investing actually works in practice. The last term in part 2: liquidity. Liquidity is how easily you can buy or sell something without moving its price. A highly liquid asset has millions of buyers and sellers at any given moment. A low liquidity asset has very few. The clearest example: cash is the most liquid asset in the world. A house is one of the least. You can hand someone a 500 rupee note in 2 seconds. Selling a house can take 6 months and several negotiations. In stock markets, the big index stocks like Reliance, Apple, HDFC Bank, they're highly liquid. You can sell crores worth of shares in seconds without the price flinching. A small, obscure company on the same exchange might trade only a few times a day. Try to sell a large position in it, and the price collapses simply because there aren't enough buyers waiting. Why does this matter for regular investors? Because liquidity is what lets you exit when you need to. An investment is only as good as your ability to convert it back into cash when life demands it. A medical emergency, a job loss, a down payment. Illiquid investments can be excellent on paper and useless in practice. Remember this term, it connects everything that follows. Part 3, the Puppet Master. What actually moves the market? We start with the repo rate and the Fed rate. We covered this in detail back in episode 2, but it deserves a refresher because every finance article references it. The Fed rate, short for the federal funds rate, is the interest rate set by the US Federal Reserve, America's central bank. The repo rate is its Indian cousin, set by the Reserve Bank of India. Different names, same job. Both are the rate at which the central bank lends money to governments. Think of it as the price of money itself. When central banks raise this rate, money becomes expensive. Loans cost more. Businesses borrow less. The economy cools. When they cut it, money becomes cheap. Loans flow freely. The economy heats up. That's why a single 25 basis point change, a quarter of 1%, can move trillions of dollars in markets within minutes. Now that you know what the Fed rate is, dovish and hawkish becomes easy. A dovish view means the central bank wants to cut rates or keep them low to support growth and jobs, even if it means tolerating a bit more inflation. Doves are gentle. They prioritize the economy running warm. A hawkish view is the opposite. Hawks are aggressive. They lean toward raising interest rates or keeping them high to fight inflation, even if it means slowing the economy down. You will rarely hear a central banker say, "I'm hawkish today." Instead, they speak in carefully chosen phrases. Concerned about persistent price pressures is hawkish. Mindful of downside risks to employment is dovish. Markets employ entire teams of analysts whose only job is to decode these phrases. Here's the useful part. Hawkish is generally bad for stocks in the short term. Dovish is generally good. Higher rates make safer investments like bonds more attractive, which pulls money out of stocks. Lower rates do the opposite, but generally is doing a lot of work in that sentence. Markets are complicated. Don't bet the house on a single word in a Fed speech. Part 4, the instruments. What you can actually buy beyond stocks. Before we get into bonds and debt, we need one word: yield. Yield is the return you earn on an investment expressed as a percentage. It's most commonly used for bonds and debt instruments, but it also applies to dividend paying stocks and rental properties. Simple example: you buy a bond for 1000 rupees that pays you 70 rupees a year. The yield is 7%. That's it. That's the whole concept. The reason yields matter is because they move in the opposite direction of bond prices. When bond prices rise, yields fall. When bond prices fall, yields rise. This sounds counterintuitive until you remember the bond's interest payment is fixed. Only the price you paid for it changes. If you paid less for the same fixed payment, your yield is higher. You'll see phrases like the 10-year US Treasury yield jumped to 4.5%. That's the return investors are getting for lending money to the US government for 10 years. It's also the most important number in global finance. Every other interest rate, mortgages, corporate loans, emerging market debt, is priced relative to it. When treasury yields rise, money flows out of stocks into bonds. When they fall, the opposite. This is the hidden machinery behind a lot of those market headlines. Next, the money market, the most misleadingly named thing in finance. The money market is not where stocks are traded. It's not the stock market with a fancier name. It's an entirely different thing. The money market is where short term debt is bought and sold, usually debt that matures in less than a year, treasury bills, commercial paper, certificates of deposit, interbank loans. In plain English, it's where banks, governments, and large companies park cash for short periods and earn a little interest on it. You've probably interacted with the money market without knowing it. If you've ever heard of a money market fund or a liquid fund, those are mutual funds that invest in money market instruments. They're considered the safest, most boring corner of the investment world. You won't get rich. You won't go broke. You'll earn slightly more than a savings account with slightly less liquidity. When you see headlines like "money market rates rose today," it means the short term cost of borrowing went up. which usually means central banks are tightening, which usually means the Fed rate moved or is about to. Everything in finance connects eventually. Now, debentures, an old fashioned word for a simple thing. A debenture is essentially a loan you give to a company in exchange for fixed interest payments over a fixed period. If that sounds like a bond, that's because it basically is. The technical distinction: bonds are usually backed by specific assets of the company, while debentures are typically unsecured, backed only by the company's reputation and ability to pay. In India, the term debenture is used much more commonly than in the US. You'll see them as NCDs, non convertible debentures, issued by companies that want to raise money without giving up ownership. They offer higher interest rates than fixed deposits, but they carry more risk. If the company goes bankrupt, debenture holders are behind secured lenders in the queue. The simple way to think about it: a fixed deposit is lending to a bank, a debenture is lending to a company. The company pays more interest because the risk is higher. You're being compensated for trusting them instead of the bank. The last term in part 4, fallen angel. One of those terms Wall Street invented because plain English felt too boring. A fallen angel is a bond that was once considered safe, rated investment grade by credit rating agencies, but has since been downgraded to junk status. The angel fell from heaven, in the language of bond traders. Why does this matter? Because credit ratings determine who is allowed to own a bond. Many large institutional investors, pension funds, insurance companies, they are legally required to only hold investment grade debt. When a bond gets downgraded, these institutions are forced sellers. They have to dump the bond regardless of price. That can crash the bond's value far beyond what its actual risk justifies. For brave investors, this creates opportunity. Fallen angels are sometimes oversold. The company might still pay back its debt. It's just no longer rated as safely as it once was. Buying fallen angels has historically produced strong returns for investors willing to do the homework. The phrase also applies loosely to stocks. A high quality company whose share price has crashed for reasons that may be temporary. Same idea. Something that was loved, then abandoned, and might be worth a second look. Part 5: The Danger Zone. What amplifies everything above? Just one word: leverage. Leverage is using borrowed money to increase the size of an investment. You put in a little of your own money, borrow the rest, and control a much bigger position than you could afford on your own. The simplest example most people understand: a home loan. You buy a 1 crore rupee house with 20 lakh rupees of your own money and 80 lakh rupees borrowed from the bank. You've used 5 times leverage. If the house rises 10% in value, you didn't make 10% on your investment. You made 50% on your 20 lakh. The other side is uglier. If the house falls 10%, you didn't lose 10%. You lost half your money. Leverage cuts both ways. It magnifies gains and magnifies losses in equal measure. In stock markets, leverage shows up as margin trading. Futures, options, derivatives, same principle. Borrow to buy more than you can afford. The catch is that markets move fast. A position that's down 20% with no leverage is uncomfortable. The same position with 5 times leverage is gone, and you owe money on top. This is why so much of investing is really about surviving long enough to compound. Leverage takes that option away. So, where does all of this leave us? Every industry develops jargon. Doctors have theirs, lawyers have theirs, engineers have theirs. But finance jargon is different in one specific way. A lot of it was invented to sound impressive, not to be precise. A haircut is a discount. A dead cat bounce is a small temporary recovery in a falling stock. A fallen angel is a downgraded bond. None of these terms needed to exist. Plain English would have done fine. The reason they exist is partly tradition, partly humor, and partly a moat. The harder finance sounds, the more justified those advisory fees feel. Once you realize this, that the language is theater, not substance, you stop being intimidated by finance articles. You start reading them the way you'd read a sports column. with curiosity, not anxiety. The bottom line: Wall Street talks complicated because complicated sells advice. The actual concepts behind these words are simple: market moods, volatility, indices, central bank intentions, yields, short term debt, borrowed leverage. Once you can translate the headlines, you realize the financial press isn't telling you anything most people couldn't figure out for themselves. The jargon was the only barrier, and now it isn't. That's the entire point of this series. You don't need a finance degree to invest sensibly. You just need to stop being intimidated by the people pretending you do. And with that, we close out season 1 of Fundamentals of Investing. This is the ninth and final episode. We started with what inflation actually is. We walked through assets and liabilities. We looked at investment products. We talked about risk, time horizons, the math of compounding, and now we end with the vocabulary itself. If you've stuck with me through all 9 episodes, thank you, genuinely. You now know more about investing than most people who work in adjacent industries pretending they understand finance. Season 2 is going to be different. We are moving from fundamentals to the real world, the latest news, and how it actually affects your money. How do you invest when there's a war in the headlines? What do you do when inflation keeps rising? How should regular people think about their portfolio in a world that feels permanently uncertain? That's where we're headed. The fundamentals are done. Now we put them to work in the world we actually live in. If you've enjoyed this season, please follow The Unlearned Investor on Spotify and subscribe on Substack at unlearnedinvestor.substack.com. New episodes for season 2 are coming soon. Until then, see you and take care. Signing off, The Unlearned Investor.